Perfect.
Are your evolutions? Yeah, we can see it.
Yes. All right, perfect. All right. Well, good afternoon, everybody. Thank you so much for having me here. Everyone, Grace and 7X, thanks for the invite. Glad to be the last speaker here of the day. The topic that I will speak with you guys about is the mix of real assets and stablecoins. By way of background, my name is Garcia. I'm the founder here at fortunafi Reservoir. fortunafi is a cross-chain RWA issuer, and Reservoir is a multi-collateral decentralized yield-bearing stablecoin. So I'll kind of get into a little bit of market overview, a little bit of why now, and then a little bit about how this works. And then we'll take some questions at the end. So in terms of a market overview, I'm sure most of you are aware that the stablecoin market cap is probably the largest chunk of the crypto market cap. I think it's, personally, my perspective, has been the strongest product market fit within crypto, and probably one of the biggest segments that are ripe for disruption at this point. So this stablecoin market cap is primarily composed of USDT and USDC at about 170 billion for the two. And then there's a handful of others that are emerging and growing in this space, and we'll get into that in a second. You can see here the value of total locked real assets on chain have also grown exponentially. It's still at a much earlier growth phase than the stablecoin landscape, but it's sort of been the driving force behind a lot of the new stablecoin designs, and what we're seeing is it's showing up in the data like this. This general segment of real assets is comprised by a lot of different types of assets. It includes T-bills, which have been very popularized lately. We have tokenized gold. We're getting tokenized stocks more and more, and also tokenized institutional funds. All of this is making its way. Yeah?
Yeah, sorry to interrupt. We cannot see the slides.
Oh, you cannot.
Yeah. Can you share the screen? Oh, okay.
Yeah, can you see the screen here?
Yeah, you're moving. Yeah, we can see it.
And when I go into slideshow mode, it looks like it's not taking me through it.
Yeah, maybe we can just show it like this.
Sure. Let me just zoom in here for everyone. Okay. So I'll kind of go through it here. So went through the stablecoin here. Here we're talking about the total TVL for real assets. We talked about the breakdown. Here we can see sort of the data showing the cumulative transfer volume across stablecoins. This is a number that's just constantly scaling, which is obviously showing a lot of indication of utility of actual stablecoins. On the Google Trends score, we can see that real assets have been trending quite high this past year. There's been a lot of discussions, a lot of innovations, and a lot of sort of research from leading institutions sort of prophesizing the growth of this space here. Here you can see a handful of large institutions that have sort of made announcements, right? PayPal's launching a stablecoin, Citibank's exploring tokenizations. Franklin Templeton already has a tokenizing product live today. It's their tokenized treasury product, but they are certainly exploring all of the other ETFs and mutual funds that they have. New Laser Digital have been very active in the space on both RWAs and stablecoins, and obviously BlackRock, which everyone has, I'm sure, heard of, has been getting very active and is certainly also planning on tokenizing all of their treasuries. I can also say that I've spoken with several other ETF issuers, and this is definitely a topic across all of them, not only tokenizing their existing products, but new products, and also sort of exploring the stablecoin landscape space. We've seen a number of sort of large estimates from institutions on sort of what the size of the space could look like in the next 10 years. We've come out with our own sort of analysis comparing sort of growth of crypto and growth of internet and sort of the existing adoption of RWA we've seen. And we're expecting 30 trillion by 2030. I think even if you take some of the more conservative assumptions in this space that have been produced, that's still a significant increase from where we're at today, which I can bring you back here and remind you we're at about 5 billion. So that's a pretty significant increase from now. So why tokenization now? Why is this being talked about? Didn't we have some initial pushback in 2017 and 2018? Why did those fail? Why are we really talking about this now? I think there's two main reasons for that. One of them is that the DeFi ecosystem was basically non-existent back in 2017, 2018. So there was very little reason to actually hold these tokenized assets on chain, and there's very little things you could actually do with them. And the second thing was that decentralized stablecoins really hadn't taken off yet. We basically had Maker at the time, which was originally only built for digital assets. They've since sort of expanded with their legacy infrastructure, if you will, to doing T-bills. And have had some issues and some success with that, but we didn't really have a proper infrastructure across stablecoins and DeFi for tokenization to take off. Whereas now we're starting to have this change. So the stablecoin opportunity is immense, right? I've talked about Tether and Circle. I just recently talked about Maker here. We've seen a few new stablecoins, right? The sort of existing legacy stablecoin is a traditional dollar-pegged stablecoin where the issuer is maintaining all of the interest generated on the assets on the balance sheet. What we're starting to see now in terms of trying to take some of that opportunity from them and drive more value to users is the concept of yield-bearing stablecoins. The concept of yield-bearing stablecoins start to really make sense once you understand how real assets are being brought on chain and how these are sort of helping scale some of this. So on the Athena side, right, they're basically backing themselves with funding rate arbitrage. You have folks like Ondo that are backing themselves with T-bills. And so what you have is you have a new layer of decentralized yield-bearing stablecoins that have generally been single asset backed. There's different pros and cons of having a single asset backed yield-bearing stablecoin. The bigger con is generally that you're relatively constricted on growth and on yield because market cycles change and the profile, the risk, and the yield of underlying assets change dramatically. On the T-bill side, it's obviously much more conservative, but as yields on the T-bill side go down, they will be less competitive with other sort of opportunities on chain. And so, in our view, there is a humongous opportunity to build a multi-collateral yield-bearing stablecoin. And that's what we've been working on here at Reservoir, and happy to sort of go into details. But I think it's important to kind of understand that the RWA opportunity and the stablecoin opportunity go hand in hand. And we sort of fundamentally believe that the best stablecoin will be backed by a variety of different high-quality assets, both RWA assets and traditional on-chain assets. So how does fortunafi work? How does tokenization work in general? So taking you through this high-level tokenization stack, if you will. At the highest level, we call it sort of the layer one. You have the originating, the underwriting, and sort of the legal infrastructure behind the tokenization. This has typically been a team of credit professionals or an outsourced group helping folks. In our particular case, we have our own fully built out underwriting team, and we partner with other institutions to tokenize their products. But effectively, there's this underwriting layer and legal layer. So in most cases, it's a private fund structure. In some cases, there's been certain jurisdictions that have approved tokenizing direct securities. Again, there's some pros and cons there. They can only tokenize direct tickers. It's a bit harder to tokenize an institutional fund in that particular jurisdiction, but in our particular case, we use BVI. We have a fund structure, which is the more common structure, and I think works really well. Going out to the level two is you sort of have the smart contract layer, basically the tokenization of that off-chain asset. There originally have been many different smart contract layers doing the tokenization, in some cases the tranching or securitization, if you will, of the pool of assets. We have built this from the ground up, and as we used to use Centrifuge, some of you may be familiar with that. We've since built our own sort of tokenization app. You can see sort of the UI on the right. But effectively, we allow any user or entity to onboard. They do their KYC, AML. We can onboard both US and non-US. And once you're onboarded, you can pick an asset, you can pick your chain, and you can mint there directly. So today, as you can see, we have T-bills. We have an equity index, which is the S&P and QQQ mix, 50-50. We have a spot Coinbase product and a spot Robinhood product. In the next few weeks, we'll be launching a delta neutral product by a large institution called Hilbert Group, which will be providing a 15% delta neutral yield with a max 2% drawdown and daily liquidity. So the longer term vision is really supporting all kinds of tokenized assets through the fortunafi application and infrastructure, and enabling sort of support on any chain that has demand for this, and enabling users to actually use these assets across DeFi and sort of find ways to monetize it on chain as opposed to just holding it in a brokerage account. The third layer here is the third and fourth layer are basically the liquidity layers on chain. The third layer is really your D2P cross-chain liquidity, right? This is your lending markets, this is your permissioned pools, this is your yield vaults, this is your base layer of DeFi infrastructure. The fourth layer, in our opinion, is the true liquidity layer of crypto, which is the stablecoin layer. So we very early days worked with MakerDAO in terms of bringing tokenized real assets to their balance sheet. Since then, there's been a number of protocols and stablecoins looking to integrate with real assets, and we've been looking to support many of them. And as I've mentioned before, we've been developing a stablecoin called Reservoir to be backed by both real assets and digital assets, which I'll get into here in a second. But we think that the scalability of a purpose-built stablecoin that's multi-collateral, that can onboard both traditional assets and digital assets at scale, will be a major inflection point for real assets and decentralized stablecoins more broadly. So how does Reservoir work? I won't get into it too deep because I know we're starting to run out of time here, but at a high level, we have 4 core primitives. We have a stablecoin that's pegged to dollar with no yield. It's a traditional stablecoin, more used for sort of borrowing and LPing and trading and sort of more retail use cases. We have a yield-bearing product which you can mint with our stablecoin, and it's called SRUSD. It'll earn a yield from the protocol, but it's fully liquid. You can mint and redeem anytime. It's fully composable and will be cross-chain supported as well very soon. We then have a term version of the yield-bearing stablecoin, which effectively you're locking up your stablecoin for 3, 6, 9, 12 months, and you're getting a bond token, which is a fungible token that collects coupon payments every quarter, and then the remaining principal and interest at the end. This token is also composable. I believe it's actually the first coupon-based bond that's been created on EVM so far. And then we also have a repo market, so users can come in and lock up a variety of different collaterals and mint our stablecoin on a fixed or variable rate basis. I think one of the core things about our particular stablecoin is not just the fact that it's multi-collateral, but also the fact that it has a duration-based balance sheet. So the introduction of a bond to a stablecoin allows the stablecoin to have non-liquid assets on the balance sheet that can match the maturities across the assets and liabilities. So for example, if the protocol has a 12-month bond product, that represents about 10% of the TVL of the balance sheet of the protocol. The asset side of the protocol can also onboard assets that match up to 12-month durations, and this sort of provides a differentiated source of yield and collateral as well. That should help the protocol grow. Here, just kind of quickly talking through the balance, there will be both traditional DeFi native sources of that balance sheet, as well as traditional tokenized real assets. So on the DeFi side, we're going to be supporting money markets. Like I mentioned, there will be a Reservoir money market where you can mint our USD with a variety of different collateral backings. We'll be supporting liquidity pools. You'll also be able to borrow against different LP positions in the money markets that we're building. We'll be integrating with a bunch of different exchanges and wallets and protocols as well there. And on the real asset side, we can support a variety of different assets. At the start, we'll have T-bills and this delta neutral product, but we can add through governance support a variety of different assets to keep growing the balance sheet there. This just talks a little bit more about the products. I sort of went through it here briefly, but I feel like this could be a good point to open up for questions. If anyone has any questions, I'm all ears.
Yeah, any questions? Yeah. No questions right now. I think everybody's pretty tired after the long day. And yeah, thanks for giving us here. And we'll post the videos later and get something on it.
Absolutely. Thank you, everyone. Really appreciate the time, and best of luck with the rest of the ECC. Thanks.